Thursday, January 29th, market bloodbath. $6 trillion wiped out in 60 minutes as gold and silver crash system exposed. Nassar Jassara on Telegram. On January 29th, 2026, the global markets were hit with one of the most violent flash crashes in financial history. Within a single hour, nearly $6 trillion in paper wealth evaporated. Gold plunged 8.2%, silver collapsed 12.2%, and U.S. stock indices followed as panic gripped the trading floors. This wasn't a correction. It was a full-scale liquidity implosion and a signal that the system is far more fragile than anyone dared admit. The charts told the story before the headlines did. Gold dropped from over 5,500 to 5,117 in minutes. Silver tumbled from 119 to 109. Nasdaq and S&P 500 lost hundreds of billions in market cap in a synchronized vertical drop, triggered by leveraged unwinds and automated liquidation algorithms. The moves were not gradual. They were straight-line collapses across all screens. According to real-time data, the losses were staggering. Gold's market cap dropped by nearly $3 trillion. Silver wiped out $760 billion. The Nasdaq and S&P each lost over $700 billion. In total, almost $6 trillion disappeared, not over a week, but in less than an hour. These were not rumors or clickbait headlines. These were live losses confirmed by trading terminals and global exchanges. So what caused the crash? Not economic data, not news. This was a margin call chain reaction fueled by excessive leverage. As gold and silver surged in recent weeks, due to growing distrust in fiat systems, traders overexposed themselves. When the tide turned, it triggered forced liquidations, dragging down tech stocks and triggering cross-asset panic. It mirrored past flash crashes, but hit harder, faster, and more broadly. Ironically, precious metals led the collapse, even though they were seen as the safe havens, but the reason was clear. Overcrowded trades, profit-taking cascades, and algorithms programmed to dump risk on cue. Gold and silver didn't fall because they were weak. They fell because too many were holding too much, and the exit got small fast. Beneath it all was a deeper current, a collapse in trust. Investors ran to metals to escape fiat collapse, but when margin calls hit, even hard assets were liquidated. The crash did not reflect a failing economy. It reflected a system running on illusion, one where trust vanishes faster than capital. What comes next is unclear. Some analysts predict a quick rebound. Others warn of a broader liquidity freeze that could spread on into crypto, real estate, and sovereign debt. Some expect central bank intervention or trading halts. One thing is certain, the cracks are no longer theoretical. They're flashing red across every market. This wasn't a dip, it was a dress rehearsal, and the next time, it may not stop at $6 trillion.